All right, well, it's been a crazy week. I'm back on with you last night. My flight didn't actually get in. I didn't get home from my flight last night until 3 a.m. That's why we didn't have the market outlook last night. I was scheduled to do it, just didn't have any gas in me early this morning to get it done, as well as catching up on everything to do. But I'm here today in place for Brandon on a Tuesday, and we're going to take a look at the markets and what's been going on this past week from my perspective and how that impacts our market posture going forward. So let's go ahead and get started. Today is Tuesday, July 31st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, thanks for tuning in, everybody. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo in the bottom right corner of the video. Click the red subscribe button that pops out there. Also, click the thumbs up icon down below the video. That lets me know two things. You like tonight's video, you want me to keep doing them. Comment down further below on anything that stands out to you from tonight's video. There's a link popping out in the top right corner of your screen. Click on that link. That will subscribe you to our daily Market Outlook email list. Follow me on Twitter for more content like this throughout the day. And of course, join our Market Outlook community that we have on Facebook. All right, well, let's take a look at the S&P 500 first and look at that market forecast indicator like we always do. You can see down at the bottom, the green line's been falling since that overbought cluster that we got a couple of weeks ago, but it's still above the 80th percentile. And so even with this little pullback we've been having this past week, well, up and down, mainly at the end of last week, we're still bullish. We're still strongly bullish. In fact, the shading is still dark green here on the S&P 500. So yeah, you can get pullbacks in the short term, even as deep as that one was, to pretty much all the way down to the previous near-term low point, which is this dip here. Now, you'll notice that we have been getting progressively lower near-term highs, and they've been progressively getting higher highs. And so the target on a divergence, when you have a divergence near-term high like this, where your lower highs down here with corresponding higher highs, the target of that divergence is the low point in between. And that's where we got to on an intraday basis there. Not bouncing sharply off of this yet. We didn't close up above yesterday's high. We were at one point in time just briefly above it, but we did pull back off those highs. You'll see here in a minute on another chart. That kept the short-term lines kind of down here, coming off this bullish intermediate confirmation signal that we had on yesterday, on Monday, with that oversold momentum line combined with the strong bullish posture. In this case, also with the near-term line down below 50, with it's a little smidgen below 20. You prefer it not to be below 20, but it's just dipping its toe into the water there, so it's not too significantly bearish. And of course, the momentum line, what you want to avoid that one is getting below the 5th percentile, and it finished right about the 8th, almost the 9th percentile there. So not an extreme low on the momentum line that would be too significant. Like I said, still holding the old near-term low point where my cursor is, and not dipping below that yet. So that's, you're coming down from a higher near-term high, and you're still not breaking to lower near-term lows yet. At the worst, you're equal near-term lows, if not slightly higher. So the short-term trend's actually still intact, and that's why your bullish posture is still strongly bullish. That's not the case for everything. We'll see here in a second. But that's the case right now for the S&P. In fact, market sentiment continues to rise. Long-term market sentiment continues to push up higher, getting closer now to that upper reversal zone where it kind of solidifies. So you're still, again, this bullish intermediate run started with that kind of breakout move right there on July the 9th. And so we're going on a month of this intermediate run going, and it won't end until the intermediate line crosses below 50. We expect that run to last 1 to 3 months. We're kind of expecting a little bit longer because of that overbought cluster that we got, which usually solidifies an intermediate run. So we'll see if that, when it's early on. Of course, when it's at the end, when you're 1+ month into an intermediate run, you start getting overbought clusters, then you start looking at those as exhaustion type moves. But when it comes at the beginning, like well within a month, then that kind of solidifies the run. So, again, we'll see if that is the case, at least with the S&P 500, and for that matter, the Dow Jones Industrial Average, which continues to look strongly bullish too. Its short-term sentiment did not get as bearish. One thing to keep in mind, the short-term sentiment here did not stay above 50 for that 7 to 12 days. In fact, you can see here the S&P is 1, 2, 3, 4, 3 days. The fourth day got just a little bit below 50. So we only had 3 days and just barely essentially getting up to a divergent high point in the upper reversal zone. So not the most bullish high, even though it was a higher high, not the most bullish high. Little cause for concern there. The fact that we haven't broken below that divergent target yet, low point, the previous near-term low, is a positive sign that we're not as bearish as we could be. And of course, not anywhere close to breaking below the low point. The S&P, remember, hit that near-term low point. The Dow, of course, hasn't. So it kind of shows that those large cap stocks have been holding up better. Of course, the FANG stocks have not been. You'll see this low point here, we did break down from what could be a bearish near-term high point. It was a divergent high point, but its peak did not get up into the upper reversal zone. Only spent a couple of days above 50. So really bearish high point there, and you can see how that played out with more of a bearish move, in fact. So we got below that near-term low. We're still, this is the intermediate low point. This is the intermediate low point here. And here, let me just throw right here, open, high, low, and close. We'll throw this on. Whoops. No, I don't want it there. There we go, to that one, and then up to this high. So you can see we've dropped down to that 62% Fibonacci retracement level, basically to the bottom of the Fibonacci retracement zone with yesterday's move, and so far I've held it with this little Harami pattern that's developing today. Short-term sentiment is still pretty oversold, so we're not out of the woods. And the near-term line did dip more than its toe under the water, starting to get a little ankle deep there. So that is more bearish, and of course, because of that, the intermediate posture actually is bearish. Market sentiment's in the upper reversal zone, so it's strongly bullish. Long-term trend's intact because of previous moves that this index has had, but this weakness has been strong enough to produce a weak bearish posture. Not strong enough to stop the intermediate run, right? Remember, the intermediate run doesn't stop until you get the dark pink. We're still shaded pink, light pink, because we haven't fallen below 50 yet. So we'll see if this ends up being temporary and we hold this support and bounce off with this bullish Harami pattern, or if we break down below 7,600, and of course at that point be a lot more bearish here. Of course, you expect things to hold, support to hold until it doesn't. So considering the trend and the posture, we'd expect that we would bounce off of this and continue to move higher. The Russell 2000, you can see we closed was a smidgen up above the high, just more than a point above the high of the low day during this pullback. That kept its intermediate line from dropping below 50. At one point, it was below 50 when it was down a little bit lower. So it's been a little bit more bearish than any of the others. It's obviously dipped below its last couple of near-term lows. And of course, there's the intermediate low point that we are well on our way to retracing. So a little bit of a ascending triangle developing if this little bounce holds on the short-term level. Not very strong, so, and again, it's pulled back more of that intermediate, through the intermediate, the Fibonacci retracement zone here. I'm going to save that on there. So if you notice, whoops, did not want that. There we go. Up to that high point there. You can see we did dip below the Fibonacci retracement zone. So a little bit more bearish than the Russell 2000. And that's really not the one that we want to be more bearish. So we'll see if that ends up playing out. Gives us a little cause for concern for the rest of the postures. Remember, we're strongly bullish still on the S&P and the Dow because those intermediate lines are in the reversal zone, even if this is pulled back a little bit. So we're still got this persistent bullish trend. Its market sentiment is still above 80. So the long-term trends are intact. There is some weakness showing up here. Of course, you need to account for that weakness when you're trading with the trend, which is bullish in this case, and you account for that weakness by accounting for that risk with your risk management, with smaller positions, fewer trades, less aggressive bullish trades as you wait for some of this murkiness to work itself out. All right, a reminder for those of you watching the Market Outlook video on the Market Scholars blog. Remember, we asked for 3 clicks to let us know that you want us to keep doing these videos. So do that by clicking the like here, where my cursor is, on today's Market Outlook tweet. You click on that button, it'll pull up your Twitter account. Click on this icon, it will pull up your Facebook account where you can like the post there as well. And then, of course, the 3rd click would be to like it here on the blog. Remember, I want to hear your questions or comments that you have. You can do that by clicking on this link right above the video. It takes you to the Market Outlook forum here on marketscholars.com, and where you can post down below on any questions or comments that you have. Remember, you have to subscribe up here in the top right to be able to do that, but you can do that for free by clicking on that link and following and filling out the form there. Now, while I was on vacation, there was a lot of doom and gloom. In fact, there was some bearish charts that I shared on Twitter, but this chart should put a lot of this weakness that we've had in context a little bit. We're still above a rising 50-day moving average. It's still above a rising 200-day moving average. So, we don't fall off a cliff until we're usually below a 200-day moving average already, as it is. And usually we don't really test that 200-day, drop below it and stay below it until the momentum line, this MACD line down here, which measures the gap, falls back down closer to 0. See, it's actually still rising. So we're above a rising 50-day moving average and a rising 200-day moving average, and the gap between those two lines is also rising. So it's hard to be too bearish when you have that long-term backdrop there on the S&P 500. When you take a look at the 3 green arrow chart, of course, we don't have 3 green arrows anymore. We have 2. We're still above a rising moving average, so we don't have a pink shading yet. But we don't have we lost the positive momentum. We have some negative momentum now. And of course, the bears have the ball, so to speak, from the stochastics indicator. If you look at the 2-line versions of these, MACD and stochastics, while they are below their moving averages, they are both still in the upper half of their charts, just like that falling intermediate line. So at least on the Nasdaq and the composite and the Nasdaq and the Russell, you see we have broken below the 8-day moving average, which is the first test of a bullish move. But the second test is the 17-day, and we've held that so far. So, in fact, we're back up above the 8-day moving average just a little bit. So we'll see if that test ends up holding and both these lines rally up. And again, which is what I would expect considering the time frame that we're expecting from the market forecast indicator. From an intraday perspective, you can see today's move. We had a higher high and a higher low on the S&P 500. We did finish back down in the middle of the range, back below yesterday's high point. So that's not the most bearish pattern here. Let me get rid of this this line here. There we go. That's not the most bullish pattern, excuse me. But it's not bearish either. We were bearish here on these 2 days. Also consider we're still in the upper half of the 4-week range. Now this line is going to start moving up because this is going to come off and we'll start moving it up here with each successive low point. So that was probably going to start pushing this dotted line, the midpoint, up into this area. So, it's going to start tightening up. So until we break out and start pushing the upper band up again, which will, be even more bullish, as long as we're in the upper half of the chart, you're okay from a short-term perspective. In other words, the chart shaded green here. It would be dark green if not only you had the higher low rising, but you also had the higher high rising as well over the 4-week period. If you take a look at the volume chart here, you can see just a little bit above average. The trading range, as you probably saw on this other chart, the trading range here was below average too. In fact, if you take a look at SPY, it's 1.64 points, and you saw the volume just a little bit above average. Here, let's take a look at this chart here, and go SPY. So a little, 1.64 on the trading range. Then here at the bottom, 67 million shares traded. So we'll take a look at that on the chart here, and you can see 1.64 is below average, so that's still bullish from that perspective. 66 million or 67 million is a little bit above average, but still in the very, very lower end of the 52-week range for that average. And then, of course, the relative ATR is below the 1% level, which is bullish territory for that particular indicator. Looking at the volatility index, we've had a little jump in volatility, and we got the potential of forming a higher low on this hourly chart. So, of course, if we do bounce off of this higher low and move up to 15, then you'll find some resistance in that area. From a relative standpoint, we're still in bullish zones. So this rise in volatility got us into the lower end of the neutral range. Didn't even get us into the bearish range. So that should show you how bearish we actually were during this pullback. And now we're back into the bullish zone. Not quite to the sweet spot, but working our way back down towards that sweet spot. So what do you think about tonight's market outlook or market posture using the market forecast indicator and these other technical charts? There's a link popping out in the top right corner of your screen there to vote on whether you agree with this bullish sentiment that we have right now, with this short-term weakness that we expect to bounce off of it. Not fully bullish, but because of course there is some signs of weakness, but not enough signs to say that we shouldn't be bullish anymore with what the charts are showing us, right? The charts are still showing a long-term and intermediate bullish trend, obviously with some signs of weakness that tell us, that we should account for that weakness with our risk management, but not necessarily with full-on moving towards the bearish mode. So if you agree with that, click the agree button. If you disagree, click that disagree button, and then scroll down to the bottom and comment and let me know what you're seeing or what you think. All right, now let's transition into what's driving the price action today. There actually was quite a bit of news here. You can see from an economic perspective, first of all, the FOMC meeting started today, and nothing's expected to happen, and there's no press conference or anything. So don't expect anything to come out of that other than, language as to how hawkish they expect to be. You can see right now the odds for a rate hike in December, just a month ago we were at less than 50% odds that we'd get that fourth rate hike in 2018. Now we're over 71%, almost 72, well, over 72% chance that we'll get that fourth rate hike. So the odds of getting, we're going to get one in the next meeting. That's what the futures market is telling us. With that 91% odds in December, we're up to 72. So pretty decent chance. The GDP estimate you can see came out here today at 4.7% for the third quarter. So another potential strong quarter for Q3 to back up what we just saw in Q2. So that's now. From all the other economic indicators we're getting here, Chicago PMI, this is kind of a business sentiment survey, still relatively strong at 65 or 65.5. The consumer confidence survey is also still very strong, up at 127.4. So confidence levels are still pretty high. Wages and spending levels are still growing. You can see the pink line, which shows the year-over-year growth rates, are both still rising. And employment wages, employment costs at least, wages and salaries are still rising there too on a year-over-year basis. So, things are still improving, not any much more than expected. Usually, like I said before, when things are going up and economic indicators are improving, they'll usually beat estimates. Analysts don't want to overestimate. They rarely overestimate when things are bullish. They'll rarely overestimate to the downside when things are really dropping. And so right now, these indicators have caught up to analyst estimates. So they're not strong enough to continue to beat them. Otherwise, we'd be up in this area and things would be pretty bullish. But they're also not strong, and we're still not weakening significantly yet either, to where we're not able to at least match what those analysts are looking for, which have been relatively strong numbers. And so like I said, that's kept these rate odds pretty high. These go up as this stays up strong. This goes up or stays up there like it is right now. And so that's what we have going on from a news perspective. From a market standpoint, you can see which stocks outperformed today. The ones that really struggled the most the last 2 days. So really an oversold bounce here in small cap, mid cap stocks. You also see real estate and dividend yielding stocks both rallying with bonds. So bonds had a pretty strong day today. You can also see growth bouncing back up again, similar to what we just saw, kind of an oversold bounce on there as well. And then there's international stocks continuing to show strength relative to their more developed markets. On the downside, you can see crude oil really bringing commodity prices down, strong dollar, all commodities across the board dropping. There's your preferred stocks, mortgage-backed security, or municipal bonds, mortgage-backed securities, foreign bonds. They don't move really much one way or the other, but the fact that they're down here at the bottom, aside from this weakness in commodities, which you can see continues to be pretty weak across the board here, crude oil bouncing down from what would be a lower high point, gold or ag commodities on a strong downward trend. Gold on a strong downward trend with the dollar still showing a strong bullish trend and holding that strength. There's high yield taking off along with some of these other equity asset classes. Look at that strong bounce we've had in real estate stocks there. So there's still some risk appetite that we're seeing. And if you take a look at the foreign markets here, there's the S&P 500. Kind of right in the middle, and look at what's really gaining some ground. A lot of these, in this past week, since I've been gone, these emerging markets, large emerging markets like India. Take a look at India taking off, Russia bouncing back up, China breaking out last week and holding that strength, South Korea joining that and bouncing back up, and Italy, you can almost say, is like the emerging market of Europe. It's breaking up to new highs, along with his other European counterparts that are showing strength again. Germany, France over here. Look at Canada above a rising moving average. UK getting them. So they're all, you notice, getting above their moving averages, with the emerging markets having those lines already rising. Oops, sorry about that. Already rising here, showing that relative strength. There's Brazil down there with a rising moving average. And of course, the U.S. markets still showing that relative strength, still showing a strong bullish posture with this intermediate line above 80. And the only other ones that have strong bullish postures, according to that that definition, is India, Canada, and Brazil, with all their intermediate postures up above 90. The weakest ones here continue to be China, the UK, and down here South Korea have the smallest. But the rest of these, France getting above 50, Italy getting above 50, not as much, but France and Germany getting above 50, Japan getting above 50 and rising, still have falling moving averages, but they're getting up above them to the point where they can start turning around again. So the U.S. Markets have enjoyed some relative strength for the longest time, and it appears that might be starting to rotate towards these really beaten up international areas. All right, now let's take a look at the sectors and their performance, and you can see I've got them up here, and the tariff. There's the idea that the tariffs might not be as strong now. There might be a deal coming together between the U.S. and China, and that's really led to some strength in industrials, some really renewed strength up above its moving average. Materials as well; those have been really beaten up. You can see real estate's bouncing up and bouncing off of a higher low point and getting up above recent highs. Healthcare continues to be a strong sector. These are all the sectors that outpace the market today. Technology and discretionary showing some weakness. They've been the leadership lately. They've been the ones that they've had some really strong growth. I mean, look at 8%, 7%. So they've had some really strong returns over the past few months. So they're just giving back some of those strong returns now. And then, of course, you can see utilities and healthcare with the rise in bonds today, long-term bonds with the drop in yields. Those two areas doing really well. Staples is still strong. It's still holding up lagging the market a little bit today, but still holding up above a rising moving average. Telecom, it's not necessarily the case, and you can see energy still kind of struggling along in this sideways move, and financials breaking down with the fall in yields as well, but still strong posture. We got some strong trends across the board with some relative weakness in technology and discretionary, as well as some growing trends here in real estate and materials. You can see they're starting to take off a little bit. In fact, over the last few weeks, you'll see that some of the best performing sectors have been technology and discretionary. They've been so strong for so long. They're still kind of up there in terms of the top sectors out there, but healthcare still maintains its strength. Financials has not been as strong of a sector. You can see it only of last few months. It's got one of the worst. In fact, it's only got 2%. The only industry worse from a return perspective than financials has been telecom. So it's down there. Of course, the biggest story, the biggest mover has been staples, which was so beaten up here, and it's taken off along with industrials starting to take off too. But you're starting to see industrials. They were the worst performer with this tariff news. If it breaks up above this high, that will be a very positive development for this really beaten up sector. It's been beaten up because of the news coming out of Washington. One of those stocks in that industrial area that you can see has been struggling quite a bit here over pretty much this whole year since the market peaked in January has been Caterpillar. Just barely had its earnings come out here yesterday. As you can see here, the initial reaction was actually positive. Then of course the knee jerk was a move to the upside because we gapped up pretty strongly and then fell all day long to the low point near the close of the day yesterday, but today bouncing up about 3%, and you can see that was representative of pretty much most of the stocks in that area. The industrial sector bouncing up the most. Again, with the rumors out there that things might be softening a little bit in the trade war between China and the U.S., you can see the impact that has. Just the ideas of that occurring, and so. Positive move, of course, you can see we've had this high point right about where my cursor is, right about 141, these old highs here that we had gotten up above a couple of days, or last week before yesterday's post-earnings move. You can see that was kind of a resistance level for the stock, and then bouncing back up above it today. So kind of a false breakdown yesterday with a lot of volume, of course, with the earnings coming out, but then some pretty strong volume today on the bounce back up to the upside. It's still up above 1.5 times the average volume. You can see the stochastics and MACD are rising. If you take a look at those lines on a 2-line basis, you can see the MACD is actually crossing above zero. Stochastics in the upper half of the chart, the 8 and the 17-day rising up above the 30-day moving average. So positive development from the intermediate standpoint. The long-term picture doesn't look as strong, but you can see getting a back up above a 50-day moving average would be a positive sign and avoid the death cross that we've come close to getting here on the stock. Again, the broad market itself is not getting. The Dow Jones Industrial Average isn't close to a death cross, but Caterpillar has. So Caterpillar has some room to bounce back up. Of course, we don't have to be too aggressively bullish on this. You can look at selling here, this mid-30s delta, about 52 days out. We're a little bit longer. We just don't have the 45-day up there yet, and even then, these options aren't priced the best here. The relatively large spreads, and these are a little bit tighter on the spreads. So you can look at selling the 140, buying the 135. You get quite a bit of credit here, a lot more than 30%. But you still get a pretty decent odds of success. If I were to throw this onto the chart, you can see I'm getting over 60% odds of success here, and you throw that line onto the chart itself, and you can see it's back below that 141 level I was telling you about. Here, let me bring up the chart again. So here's that line where I'm talking about, where my cursor is, that we had some highs. We broke up above that, broke down after earnings, and then popping with some strong volume back up above it today. So that's kind of our resistance level. You can see that even the intermediate line starting to rise and has a chance of getting up above 50 here, with the prospects of a higher near-term low developing, with this near-term line giving us a higher low point that would also be between 20 and 50. So there's setups there for a bullish bounce in a strengthening sector in the S&P 500, doing so with a relatively high probability trade that we can manage our risk on. If we were to break down, you can see even breaking down below 138, 138 being down into this area, getting down into that area there, you can see would get me to an about $90 loss, when I have about $135 to lose before I get out of this trade. So I've got a little bit more room to work with. You can see as of right now, that'd be right around 135. Now that number is going to creep up because time decay is going to bring that purple line down. But right around 135 right now is kind of the number I'll be watching for. So pretty much below this near-term low point here. And if we were to bounce up off of this near-term low, then we'd have this new near-term low right around 140, below 139, that we can use for a support level to gauge the bullishness of this particular trade. So what do you think about tonight's trade idea? Agree, disagree? Let a comment with that link that's popping out on the top right corner. That will take you to our Market Outlook forums on marketscholars.com. Comment on today's market posture, on today's trade. If you have any questions for me, that's the place to put them as well. As always, thank you very much for watching tonight's video. Remember to subscribe to our YouTube channel if you haven't already. Click on the thumbs up icon to like tonight's video, and then a comment on anything that stands out to you. Follow on Twitter for more content like this, and join our Market Outlook community on Facebook. Have a great evening, everybody, and we'll see you all next time.